Hi, welcome to STANLIB's weekly economic podcast. My name is Kevin Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And I think this week it would be useful to focus on the South African economic data that came out last week, particularly the inflation numbers for the month of December. A very good outcome, and I think it puts the Reserve Bank on track to cut interest rates further and certainly make more progress towards achieving the new inflation target of 3%. So I think we could go through some of those data points. And then the second is South Africa's retail sales for the month of November. It was a good month. It included Black Friday spending, and it gives us an idea of how the consumer is performing through to the end of last year and an outlook for the beginning of this year. Clearly, there was quite a lot of volatility in markets last week. A lot of that related to Greenland and President Trump's approach to putting tariffs on Europe and wanting to annex Greenland. Fortunately, all of that anxiety has eased and markets recovered in the last couple of days of the week. But clearly, we're in a phase of extended market volatility and a huge amount of geopolitical uncertainty. And I don't think that's about to end. It looks like it will persist, although the topics would obviously change potentially from week to week. So for us this week, SA economic data, just a quick update on some of the key numbers developing in South Africa. So let's start with South Africa's inflation data for the month of December. As I said in the introduction, I thought it was a good outcome during the month. The headline inflation rate rose by 0.2%. That was in line with expectations. And that pushed up the annual rate of inflation a little bit from 3.5% to 3.6%. 3.6% still a decent outcome. Obviously, inflation has been drifting a little bit higher in recent months, but I would say overall it remains fairly subdued. And if we look at the subcomponents, we're not particularly concerned about any sudden buildup of inflationary pressure in South Africa. So during the month of December, two items had a material impact. The one was the increase in the fuel price. During the month, I think the petrol price went up about, I can't remember exactly, it was about 29 cents a litre. So that was one of the factors. And then the rental component of housing, that also increased a little bit and added to the inflation dynamic. But again, nothing to be overly concerned about. I think also in particular, we don't seem to have a significant food inflation concern. There was a food inflation worry early on in the year relating to meat prices and foot and mouth disease. That has dissipated a little bit, although there is still an ongoing concern about foot and mouth disease in South Africa. But it's not really causing a problem at this stage in terms of consumer food inflation. The other area that I guess we are focused on is what's going to be the increase in electricity inflation later this year. Clearly, that can create some additional pressure, particularly if NERSA is able to recoup the mistake that they made in terms of the calculation of the tariff adjustment. So we'll have to wait and see what the final decision is regarding that. But outside of that, you would say that the overall rate of inflation remains fairly well behaved. Also, if we look at core inflation during the month, core inflation went up only 0.1%, which then kept the annual rate of inflation at 3.3%. Also a very decent outcome. And so more and more you would have to say that there's evidence of South Africa's inflation rate remaining subdued, tending to surprise on the downside. And if I look at the average inflation rate that we achieved in 2025, that amounted to 3.2%. Effectively, we are already achieving the new inflation target. Now, the Reserve Bank is not about to declare victory on the new target. They've said they hope to achieve that target in 2027, and that 2026 is about trying to ensure that inflation remains subdued, in trying to ensure that inflation expectations are brought lower. and kind of embedding the new inflation target. So I think the Reserve Bank will approach all of this still on a fairly cautious basis. Clearly, though, there is still scope to cut interest rates in the short term. If I look at not just the inflation data, but if you look at where the currency is performing, that would argue in favor of an interest rate cut. If we look at a breakdown of inflation in terms of the different pressure points, there doesn't seem to be much pressure in any key category to push inflation higher. If you look at the forecast, yes, it may drift a little bit higher later this year, but nothing that's really going to cause a significant concern. So I would say there is an argument for the Reserve Bank to cut rates, possibly 25 basis points this week. It's not an absolute certainty. Most economists remain fairly divided or a little bit unsure about whether the Reserve Bank will be willing to put through the additional cut. But it's clear that inflation has performed well and is expected to remain mostly under control as we head into the remainder of this year and then 2027, and that at some point we should be able to reap the benefit of that lower inflation. And that benefit should be primarily a reduction in the cost of capital, in other words, lower interest rates, a little bit more stability in terms of the currency, we've seen some of that, and then generally more confidence amongst households and business. Keeping inflation lower certainly helps to encourage a form of consumer spending and ongoing fixed investment activity. So that is a key positive that has unfolded in South Africa, and we hope and are encouraged by the developments and expect that that will continue on during the remainder of this year. The second topic is South Africa's retail sales for the month of November. I thought it was a decent outcome during the month. Retail spending increased by 0.6% in real terms. If we look at spending over the past year, it's up 3.5%. Obviously, it was to some extent boosted by Black Friday sales, but in general, retail spending has been particularly strong over the last 12 to 15 months. Now, a portion of that is obviously related to the two-pot withdrawal that's fed into the retail spending numbers, particularly in the early part of last year. And there's an element of that continues on. In addition, obviously, we've had interest rate cuts, and at the margin that helps. And then on top of that, you would say that because inflation is fairly subdued, many people's salaries are going up faster than inflation. So that's leading to a positive outcome in terms of real disposable income, and people are willing to spend that money. And so there are a range of factors that has been supporting retail sales. If we look at the Black Friday spending itself, there were two categories that jumped out. The one was, for some reason, cosmetics and toiletries. Huge increase in the month of November. In fact, that category of spending went up just over 10% year on year in real terms. Haven't seen that type of growth in that category for quite some time. I'm not entirely sure what caused that surge in cosmetics and toiletries. And then the second was a big increase in spending on household furniture and appliances, which would include things like TV sets, fridges, freezers, those sorts of things. And I think that has become fairly standard during the Black Friday spending month. Overall, I think Black Friday contributed, but you would say that going into the final quarter of the year, consumer spending has been reasonably buoyant. If we look at spending over the last 12 months, that has averaged 3.8% growth. That's exceptional when you consider that for last year, we think the economy only grew at 1.3%. So you've got consumer retail activity approaching 4% growth in an economy that's only growing at 1.3%. That's a significant disconnect. Obviously, it tells you that the consumer spending is really buoyant, that the consumption part of the economy is what's keeping the GDP numbers at least positive, and that we're really struggling to develop the production or the industrial part of the economy, and clearly part of that links into the weak infrastructure that we've got. So no problem with consumption, household spending, retail sales, all of that remains fairly robust, but we're not really seeing the full benefit of that because obviously a lot of the retail items are imported, and therefore effectively we get a lot of money leaving South Africa when people go shopping in order to pay for those imported items. So the benefit isn't as significant as what the data would suggest, but within the context of the overall rate of South Africa's growth, these are solid numbers, and it suggests that the consumer is willing to spend most of their income, even though confidence is not particularly high, and also the fact that banks are not really granting a huge amount of household credit. If I look at credit card, personal loans, those types of categories, overdrafts, there isn't really a huge appetite by the banking sector to extend credit. So this is much more driven by household income growing and consumers being willing to spend that money. And as a consequence, unfortunately, the savings rate remains fairly low, but at least it provides some uplift to the South African economy. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorised financial services provider in terms of the FAIS Act. Also, this podcast should not be construed as advice.